Thank you, everyone, for joining us today for our webinar, Merchant Fraud is Coordinated, Your Detection Must Be Connected. And I just want to clarify from the beginning that we're not just talking about fraud committed by merchants. We're talking about fraud that may be where merchants may be the recipient. It's really any fraud that's committed within the payment ecosystem. So I'm your presenter today. I'm Victor Lee, Head of Product Marketing and Distinguished Graph Specialist here at TigerGraph. Before we get started, just if you have any questions, just put them in the Q&A section of your Zoom app. There is a separate Q&A for that, separate from the chat channel. If you can't find it, you can put it in the chat, but the Q&A is dedicated for that. And we'll have a Q&A section at the end. All right, so let's get started. So how many of you out there, this is not a formal survey, there's nothing for you to click, but just think to yourselves, how many of you have been the victim of some type of credit card fraud? Probably most of you. I have had payments, charges that I did not commit happen multiple times just in the past one year or 2 years. And my credit card company has actually been quite good at identifying it proactively and asking me to verify, was this really me or not? There was one time when I noticed before the credit card company and I had to inform them. So it's a big problem. And how big is it? So it's now estimated to be at over a $1 trillion problem. It's, far bigger than the economy of most nations. In the US, it is actually eating up nearly 10% of revenue that businesses otherwise would have. At that rate, that is enough to make a lot of companies unprofitable. Obviously, they're doing their best they can. It's squeezing margins, and it's actually a little bit of a bigger problem in the U.S. than it is in other countries. And it wasn't always that high, but it's become very high just recently. Just between 2024 and 2025, there was a 46% increase in the US. That's in dollar amount. So it's growing faster than business in general is growing. So, if GDP is growing at a few percent and fraud is growing at a 46%, that's you can see that's essentially doubling. How is that possible? Why is this happening? Well, it's happening because everything is automated now, and fraudsters are using automation. In particular, they're using AI to make fraud more compelling, to disguise it better, to disguise it better so it's harder to notice, and to more quickly generate multiple incidents. They don't need a person who's actively submitting transactions. They can write a program that is automatically making charges and collecting funds in some way. So some of the ways they're doing this is to generate convincing fake IDs. They take the seeds of maybe some partial real information. You can doctor up photos. You can automatically scan for who has maybe recently passed away and try to steal their identity. There's all sorts of ways that they can create what seems to be legitimate identities, legitimate credit card applications, etc. They also can automatically create millions of transactions. And they know how to make the individual transactions look legitimate. That's either because as an individual transaction, it looks like the sort of normal thing that people do. They could even make a short sequence or pattern of activity that looks like what a regular customer would do. If you dig further, you often can see where the malfeasance is, but a superficial look will not uncover them. And again, a lot of fraud is actually still committed by trying to uh, fool you into sending money to the wrong place. Phishing, revealing personal information, or having you send money where you think you're buying something, or you think you're buying something, or you think you're sending money to a relative, um, but actually you are a victim of phishing. And again, there often is not a real person on the other end. It's often now an AI bot. So it's this automation is enabling this rapid increase in fraud. Again, just to summarize some of the different ways: stolen cards or stolen card numbers, physically stolen, or just getting some of the information, um, somehow getting into your account, often coupled with that phishing where you were tricked into revealing some information, or again, some um, malware was installed on your computer or someone else's computer, and is gathering information from your computer because of that malware. Chargeback fraud is, again, when there's the initial transaction looks fine, but then there's a dispute, and the person wants their charges uh, charged back. I buy something, then I claim, oh, I don't want this anymore. I want to return it, but you don't actually return the thing. You just get your money back, something like that. And again, then there are fake companies out there, all sorts of things. We already talked about synthetic ID, and and those who are in industry, we talk about first party fraud, where you are the account holder, and you're actually doing you. I'm not talking about you in particular, but the person who is opening the account is doing something a little bit illegitimate, or when your information gets stolen and somebody else is using your account, that's third party fraud. Lots of different ways of analyzing it. I had more charts. That's not the important thing. The important thing is that there are many types, many different ways that uh, your information, your accounts could be used illegitimately. Now, let's talk about some of that automated and disguised behavior. So, as we know, stolen credit card information is available out there on the dark web. There literally probably millions of credit card numbers out there. Unfortunately, that's how. There was one time I got a new card. I had not even used it yet. Somehow there were fraudulent charges, and my credit card company canceled the card and sent me a new one. Again, before I even ever used that first card. I don't know what happened. Um, but so some fraudster purchases on the dark web a set of stolen credit card numbers. So there are multiple ones. It's not just a onesie twosie attack. They, again, have some agent or program which tests the cards, does a small transaction, um, to see, does this actually work? Does the card work, and am I is it being blocked? And we're talking in the $1 range often. And the cards that look legit, they then start their attack. They can either do it directly as just a single shot, or they may be like a small buildup, again, to make it look a little bit more disguised. But once they've verified that the card works, and it passed that initial test, then they start making their fraudulent purchases. Now, what I'm showing here is multiple cards and then multiple merchants. So what I want you to see is that one person, or rather one computer program, could be doing hundreds, thousands, millions of these, and that these could all be different merchants. And so from the perspective of a single merchant, they're only seeing one or a few transactions. Nothing too suspicious from their side. It's only when you see the collected activity that it becomes noticeable. And that's, as my friends, this is a graph. As I assume you joined here having some familiarity with graphs. This is Tiger Graph, but this sort of network activity. It's connected data. It's coordinated data. This is just one example. There are other types of attacks. They all show this pattern of multiple things happening in a coordinated way. There's both this breadth of multiple cards, some depth of a sequence of things or pattern of things, and that is part of the reason again why it's maybe the major reason why there's been such a rise in the rate of fraud. So let's step back and you're going to do one more introduction of a concept. Some of you may know this very well. Some of you may realize to what degree I'm simplifying this, but I am trying to keep it simple. But when you, as a customer, are buying something, either in person or online, and you select your item, you select your service, and then you provide your credit card or debit card, some account to pay for it. And in particular, credit cards. Let's focus on credit cards because it's the credit aspect that I want to look at. Um, what the merchant does is they send all this purchasing information, the card number essentially, to their bank, which we call the acquiring bank. So the acquiring bank represents the merchant, and they have the access to the card network. The card network, there are four major card networks in the U.S. Visa, MasterCard, American Express, and Discover. That is the super highway for card transactions. And remember that this structure came into existence before the web, um, Visa and MasterCard before the internet, even. So it used to be phone systems. It's obviously now internet based, but it's all very dedicated technology to handle the huge volume and the security compliance guarantees to make sure that proper business is occurring. Um, and they contact you, the customer. This is your bank. So it's basically the two banks talk to each other saying, this person I have a customer, they're supposed to be paying me this much money using this card. And so the issuer bank is going to check, is this a legitimate card number? Is this still a customer in good standing? Do they have enough credit for this purchases, right? They're checking your credit limit. And so the two banks talk to each other over the network. Once they agree this looks fine, then they send a confirmation, the transaction is accepted. That all happens in about 1 second. Um, During that time, besides just doing the checks for credit limit, it's also checking for fraud. Each of these players plays a role in trying to, because they see different parts of the whole ecosystem. It would be great if one party saw everything. From a decision making perspective, you may not want your information to be shared that globally, but if we were to make perfect decisions, we would be able to see everything. The problem is not everybody sees everything. So you as a customer, you make this purchase, you make a number of purchases over the course of a month. You may have multiple cards, you're shopping at multiple merchants. About once a month, for each of your cards, you're going to get a bill, and then you have some time to pay all or part of your bill, and then the issuing bank then collects their revenue. So remember, this bank collects fees from the activity. This network collects fees from the activity. This one also collects a little bit, but it mostly collects interest payments. Um, and they're most at risk of what if the customer doesn't actually pay at the end of the month, and that's where a lot of fraud occurs, right? This is a customer who is like not a real customer, it's synthetic identity. Create an account, made it look like a legitimate account, did some innocent real transactions, then it makes the attack. So that is in a nutshell the payment ecosystem. Again, if you're more familiar with it, you may notice a lot of more nuances, a lot of differences, but I think that presents a pretty simple picture. So let's look at it. Let's expand each of those things and think about how many players are actually involved. Um, there are, I didn't even show the persons, but I'm just showing the card accounts. So obviously, persons have card accounts. You may have multiple cards, and there may be joint accounts. So there's a whole nother layer here. Uh, but we know that there are millions of cards. There are also millions of merchants. And every day there are something like 2 to 5 billion card transactions occurring between the cards and the merchants. Again, one customer may make several purchases at various merchants. One merchant is hopefully seeing lots of business from across their different customers. Then you have the all these transactions are being handled by the acquiring banks. Or these days there's been some a little bit more modernization of this and bundling of service into what we call payment service providers, like Stripe is an example, or Square, payment service provider. I think they're maybe called Block now. But there are a lot of such companies, and there were also more traditional companies like WorldPay. Um, but we're talking hundreds, I don't even think it's 1,000 companies out there. So there's a lot of consolidation, meaning that each of these is serving many, many merchants, thousands of merchants. And then the number of issuer banks. Again, you've heard of the big ones like JP Morgan, Chase, Bank of America, Citi, Capital One, and your regional bank, here in Ohio, Huntington Bank is a major bank. In neighboring Pennsylvania, Key Bank is another major one. There are these smaller regional banks, and they're even, but and then some of those, and then you can even like say, oh, you have a NASCAR credit card, or you have a I don't know if there's a such thing as an NPR credit card. They actually are through some bank, but this is also in the hundreds. So there's a lot of consolidation here, and there's a huge amount of consolidation here because remember there are only four networks in the U.S. In other countries, like in China, UnionPay is their major network. In Europe, there are a few other networks, even though Visa and Mastercard are global. There and American Express. There's some other regions of the world that also have very major networks. But within the US, it's all concentrated into four. So of these, that means they're seeing on the order of 1 billion transactions each. What they don't see is they don't see the customer profile information. They don't see your personal information. They just understand account numbers. So it's helping you understand the volume that's involved, the connections, and who is seeing what. So now again, remember each fraudster, as we showed, they can have many cards. So in account takeover, the fraudster is using a card along with legitimate owners. So as opposed to having their own account that they created. And then each card is spread across many transactions. And then different merchants might use different acquirers because again, think you a lot of merchants will say we accept everything. We accept MasterCard, American Express, Visa, Discover. Um, and that's what you as a customer often would like. In the old days, that means they would have had to set up four different arrangements. It's now easier where they can go with sort of one service provider who's done the hard work for them, and they can just go through one provider who will give them access to all four networks. Um, but um, do remember that there is this consolidation. Each card is associated with one issuer bank and one network. So that's it's always interesting from a graph perspective. It's thinking, what is this thing? What is this merchant connected to? What is this customer connected to? What is this card connected to? How much visibility do you get? And as a merchant or as a payment service provider, how much visibility do you have? How much fraud risk are you at? Fraud risk. So some of TigerGraph's key customers are in this area of issuing banks, where they have very high fraud risk. For them, using Graph is very important. They're dealing with very high volume. They're dealing with millions of customers. They're with all the major payment networks, and and through those networks they can see something about the merchants, and they obviously they know who I buy from, right? um, so they have access to quite a bit of data, and they are also at quite a bit of risk. They're the ones who are the merchants themselves and the issuing banks are sort of on the front lines of who is going to lose out, who is actually going to lose money if there's fraud. Um, so they have some of the biggest concerns. They deal with very high volume that needs to be real time because you want that transaction processed in a fraction of a second. TigerGraph is able to help these banks by doing that graph analytics in 100 milliseconds. Payment service providers like Stripe or PayPal, Adyen, they also are seeing very high volume. They may because of the consolidation, because there maybe even fewer payment service providers, at least the top ones, have a bigger share of the overall market compared to they may be seeing billions of events. They also, because they're responsible for detecting fraud. They've incorporated their standalone firms that do fraud detection, and sometimes they work to get somebody as a payment service provider. You may provide this as a service, either because they've developed their own solution or because they're using one of these providers as an OEM. So all three of these are seeing a lot. And then we have these marketplaces where they're not selling just their own goods, but they are really a marketplace where merchants come to sell to ultimate customers. And they're also seeing very high volume. Now, they're at a little bit less direct risk of fraud. Notice there's an important distinction between what information can you see and are you actually the one who's going to lose? Because there's this is an interesting thing about these two, the marketplaces and the card networks. They are platforms for the transactions to occur, but they are uh, in many cases they are neither the merchant themselves nor the customer. The transaction is not between them. They are merely providing the platform for the transaction to occur. They may have very high visibility, but their actual direct risk of fraud is low. They're not the ones who's going to pay. What they can do is they can be a great information provider. They can basically leverage their visibility to sell that as a service to their customers. Say, we can help detect fraud, and part that is part of our enhanced value add service that we provide. And again, down it's actually when you get down to the merchants themselves, they obviously are at risk of losing from fraud too. The interesting thing is, because of their limited visibility, they have to rely on others to do the fraud detection for them in many cases, unless they're a large enough merchant that they do have a pretty good data collection. Smaller merchants have very low visibility into what's happening, and they really rely on these service providers to tell them when something is suspicious. So the answer, as we said, the problem itself is a network connected data problem. because that's the way the fraudsters work. It's not just individual one person, oh, I stole a wallet. I now have one card. Let's see what I can do with that one card. Is of course that's an actual problem, but it's not responsible for the big volume. The big volume that we're seeing is these dedicated professional criminals who are getting large numbers of stolen information or synthetic information, large numbers of volumes of activity. And that is where the solution has to be. If the problem is in the connections, the solution has to be in the connected analysis. And that's why all of these companies we talked about, I was recently at the Merchant Risk Council meeting in Las Vegas. It was a week of professionals in this ecosystem talking about the problem of payment risk, various types of fraud, and everybody realizes it's a connected data issue. What they don't all realize is what are the technologies they need to actually address this effectively. For those who are at the upper end of the scale in terms of volume and speed requirement, a scalable graph database is really your only solution. So again, working with some of the payment networks and working with issuing banks, TigerGraph has already been helping them to decrease fraud by improving their detection rates by like 20%, to make fraud investigation more efficient. So for these larger banks, they're saving $100 million a year on very large data sets of 10 terabytes or more. And again, able to do this analysis in under 100 milliseconds, under 80 milliseconds, even depending on the individual customer's need. How do we do that? It's by adding these connected data signals to their detection methods. Now, a lot of them, it's a combination of sort of real-time pattern detection as well as machine learning. So when it's machine learning, what they're doing is they're taking their data from recent activity and where fraud was identified, and they're already, even without graph, they're doing their best to look at individual transactions, look at individual customer data, and try to see what looks suspicious. But when you can collect the multi-step, multi-connection patterns, you can see more, and that seeing more is what improves the fraud detection. So there's a certain amount of data characteristics, data features you can see through regular tables of data. But when you look at it a graph, you see more features, more patterns. You enhance your machine learning model that way, and then you make a more accurate model. Now, some people think that, oh, the graph was just during the model training. It's not during the actual prediction or inference phase. That's not completely true. You actually, the customers who are doing the banks who that are doing the best job are actually looking at live graph data that they're updating continually to gather. You, models are trained based on features. So if you're using older features, you're going to get outdated results. What you need to do is look at the graph of the moment and collect revised features for the graph of the moment, and then score your model. And that's the way to get the best result. So there's both graph involved during the training phase and during the inference or prediction phase, that sub 100 millisecond phase. As I mentioned, JP Morgan, the largest credit card issuer in the US, has been using TigerGraph. It's saving in the range of $50 to $100 million because of the large number of cards, and it has the large number of customers. Nubank, the largest digital bank in Latin America, is also a TigerGraph customer. They have a significant issue in that part of the world with money laundering. And so they need to do a little bit different type of detection, detecting money mules. But the same basic technique applies. Also using graph features, graph analytics, using much of the same data, just looking at it over a multi-transaction, not just single transactions, but layers of transactions. Again, they're saving millions of dollars each month, similar number of households, and again, using multiple graph features, not just one or two, but 30 graph features. So I want to use the rest of my time to kind of go through a quick demo of how this is actually being used. These basic methods can be used not just for uh, from the issuer bank perspective, but also from the payment platform perspective. Again, the PSP, payment service provider, or the card network, or the acquiring bank. But the basic thing is everybody's trying to make a prediction model, and the prediction model, you'd like it to be 100% accurate, but it's never going to be quite 100%. This one is showing before using graph, it's in the 60% range, and you're going to make prediction errors, false positives when you think something that's legitimate, you think is fraud, something that is not fraud, if something that is fraud, you miss. That's a false negative. False positives are particular concern to merchants because they're losing legitimate business. They denied somebody business when they could have made a sale, but they were overly suspicious. They thought it was fraud and they rejected a legitimate business. They lose customer goodwill, and they both in the long run and in the short run of losing that business. So you have this dashboard of trying to understand, how am I doing? As I said, this is a connected data problem. So you need to map out the different types of connections. You have the merchants, you have the customers, the first party, you have the card itself, you have a node representing the transaction. So this is reflective of that pipeline that I was showing. It's just it's showing additional things, characteristics. What do we know about the customer? So we have both a customer 360 graph. This is something that the issuer would have. The issuer knows all these details about their customers and their address. The merchants, unfortunately, don't see all that. But that's why these third-party services, which can act as information brokers, can see some of this. So you'd better hope that your payment service provider is using something like TigerGraph to see all this information. The card network, they see all of they see this, like MasterCard or Visa, they're seeing like a huge chunk of all the transactions that are happening per day. They don't see as much of this peripheral detail. Then what you need are some of these graph analytics. There are standard graph algorithms which might serve you in some cases, such as the PageRank algorithm, understanding who are the hub nodes that are like doing an unusual amount of business for based on their context. They have an unusually high activity, and maybe very recently. So that might be a fraudster. But you also probably want a lot of custom queries. And in particular, like trying to detect that particular pattern I explained at the beginning of testing a card, and then if it looks okay, and then doing the attack. That's a multi-step, multi-layer attack, and which have some breadth where it's being done with multiple cards. And if you can trace all those cards back to one IP address, some shared information, the same phone number, something that is shared, you can get to the root of these and cut it off at the head. So that may take a little bit more custom query as opposed to more the out of the box graph algorithm like PageRank or Louvain community detection. So that's the cool thing about TigerGraph is you can do either both. You can write both custom queries like this one that's looking at the amount of transactions within a certain community. You can write multi-step ones to detect that that card testing pattern. And then you put this into the detection pipeline that I outlined. And this is showing a Python notebook that's for that. And then you compare the prediction before before you use graph and after you use graph. And that's where you get the really exciting results that, again, what our customers have seen is that after you start to use Tiger Graph, that precision and recall, the prediction accuracy goes up 20%, 30%. The errors, the false positives and false negatives drop significantly. And most importantly, the cost of fraud, the money that you're losing. Remember, we talked about 9.8% of for US businesses is of their revenue is being lost to fraud. Um, those losses drop. So the net revenue is increasing, which is the fundamental thing that a business is looking for. So that's basically how Graph, and TigerGraph in particular, is able to do such an important job of helping to take a big bite out of this payment fraud problem. So it's been growing very rapidly in recent years due to the more automated, coordinated attacks. It's costing individual companies millions of dollars, depending, just scales with the size of the business. Remember, it's like 10% of revenue. The only way to detect and stop it for those that are at the core of the payment ecosystem is with real-time scalable graph analytics. Has to be detected in real time, and with the volumes involved, with some players billions of transactions per day, it's got to be fast, it's got to have high throughput, it's got to be able to look at a lot of data and make correct fast decisions. And so those players that are most at risk are the card networks, and I can tell you a lot of them are already working with TigerGraph. Card issuer banks, payment service providers, and fraud detection services. And if you go back to the title of our presentation, we talked about merchant fraud. You don't see merchants in this list. And and again, it's not that they're not at risk. It's that they don't directly see enough of the information. What they need to do is they need to rely on those payment service providers, those acquiring banks, the standalone fraud detection providers, and it's those services. So if you're a merchant, you need to ask your providers, are you using a graph like Tiger Graph? If not, why not?